morning, Doc. We're mid-June. How are you?
Yeah, I'm good, Graeme. I guess we're all feeling the chill of winter upon us to some degree, but nothing chilly about the housing market as we continue to reveal. We've been revealing that for quite some time.
I was going to say, you see people all over the country still carrying on about the chill of the housing market, especially in winter, but month on month, we've seen growth and really pushing the precipice of this 80%, 77, 78, 75. Yeah. Auction clearance rates are strong.
They are, Graeme, and of course, as we always discuss here, that there are a really positive insight into what's happening generally in the housing market, and no surprise as those clearance rates have increased. And really, they started increasing September last year, Graeme, and we said, hey, look, these clearance rates are starting to rise. You know, they were in the high 50s, and then they moved into the low 60s and on and on. And even though prices weren't rising through the second half of last year, we did see the rate of decline starting to ease. So that was the first sign that the trend was improving. And of course, we came into 2023, clearance rates up again. And guess what? We've had 4 consecutive increases in the national house price. And I'll give you a little tip, Graeme. Don't tell anyone. But June quarter is also higher. So we'll look at the mid-month next week, I think, if we get enough time, because there's a lot of data around. But it's not moving backwards at all. And we shouldn't be surprised because, you know, we finally breached the 80% clearance mark in Sydney. We've been threatening those weekend results have been very close to 80% over the last month or so. And the weekend before last, of course, we actually got over 80%, not just a trickle over. We were just under 83%. These are very, very strong results, Graeme. And we won't give it away early because we'll look at what happened last weekend. Last weekend, of course, was what's it called? The Monarch's birthday, the King's birthday weekend.
We didn't have that in Queensland.
I don't know. I think perhaps not.
Well, no, we didn't get it in Queensland. We all had to work. I don't know what's happening there.
I think you get it on another day. Could be Eka Day or something like that. But yeah, it was a long weekend in most capitals, most states, and we'll have a look at the results, which again were quite interesting in terms of those auction clearance rates. But yeah, I don't know what people are on about. I mean, if we look at the Sydney market as an example, which has, as usual, led the charge out of the easing process last year. Of course, it was the strongest market during the boom. It was the first market to start moving backwards, to settle, which always happens after a strong cycle. Of course, it's why it's called a cycle. It goes up and then it goes down and then it goes back up again. And it led all the other capitals downwards last year. And now it's leading all the capitals back up again. And we're now seeing all capital city markets reviving, Graeme, even those ones that sort of had the cyclical effect late, and that was Adelaide and particularly Brisbane. And of course, we know Brisbane had a massive boom in 2021 and it really carried on into 2022. It started to ease, of course, higher interest rates and the normal settling process that follows very high price growth. But so it had a fading period into this year, but now it's up and running, that Brisbane market, Graeme, and its clearance rates are now becoming quite strong again. And we know that's a very big sign for the Brisbane market. Once you get clearance rates really over 50 or 60%, that means it's a very strong market. So, you know, I'm not sure what people are on about, that those that still don't believe it, but
so are we doom and gloom or are we borderline boom?
I don't know. Let's just hope we're not pig ignorant, mate. But like I said, that the issue is that, you know, you're going to be pretty happy when you go to sell your house, if you're selling it now and you realise that there are plenty of buyers around at the moment. And as I was sort of getting to in a very convoluted way, Sydney's up, and with our latest June data, Graeme, and don't tell anyone, whatever you do, but June is going to be another positive month. In fact, we're nearly pushing 6% growth to this point in June compared to where we started the year. And you know that we've been predicting around 7 to 8% growth in Sydney from the beginning of this year. We haven't sort of altered it as things have changed. We said that from day one. And it looks like we may actually be under the mark. And I think Sydney's heading at this stage anyway, if we're up nearly 6% over the first half of the year, I think the odds are that we're going to hit 10% because we only need another 4 over 6 months.
Yes, we've got that seasonal period of winter, but the spring home loan campaign, the spring buying, selling season, that's where most of our growth occurs annually. So if we're 6 now with all these rate rises, but we've got a little bit of a lull through, maybe not a lull through winter, we've got this migration, we've then got the spring home buying, selling season. You have to think we might even match the first half of the year and we could have 12% growth for the year, but that's a big call. It's a big call.
Yeah, and we'll have a quick look at the latest economic data shortly, Graeme, but some very interesting signs coming out of the US. Big decision this week in the US in regard to their interest rates. The markets there are absolutely convinced that they'll pause for the first time. So they're obviously feeling a little better about their interest rate trajectory. And we may follow them in coming months. Of course, a lot depends on the data coming through. But, that'll only help if we do get some pauses in interest rate increases. That's only going to make the spring even springier, Graeme, because it is the best or the most vigorous selling season we have. We have 2 selling seasons, autumn and spring, and autumn has a lot of energy to it, but spring's the big deal because buyers and sellers want to do the big deal, before the end of the year, and that's the motivation. And the winter pause is really about sitting around the dining room table or sitting around wherever, thinking about, hey, let's move, let's get out of here and get a bigger house, or let's go to the coast, or let's go to the country, or whatever. And those decisions that are made in July and August, they then are activated through the spring selling season. First the sellers get involved, and then those that sold have to buy, so it runs its way all the way through to the end of the year. So that's what we've got in prospect. But really, Graeme, we've had a very strong start to the year. In fact, I'll give you another little tip. A fun fact. Shall we call it a fun fact?
Sure.
So here's another fun fact. This has been the strongest May-June period in the Sydney housing market, and perhaps all our others, we'll check that out too, since 2017. So this is the strongest mid-year market, May-June market that Sydney's had since 2017.
After a dozen rate rises.
That's right, yeah. So, and all this, it's a bust, no, don't believe the data, right? And huge auction, we should be surprised these auction clearance rates are very strong, really everywhere. But, this is the strongest market conditions that we've had since 2017. Now, we're talking 6 years ago, mate. You and I were, looking a lot, well, maybe I was looking a lot younger 6 years ago, right? You haven't changed a bit, but look at me. God, what a hard life I've had. But you wouldn't believe I'm only 45, would you? But anyway, that's another story. But I'm lying. But 6 years. Best result in 6 years. So, that's something, again, if you noted it, people say, no, that can't be true. Can't be true. That's not what the media tell me, So it's all very positive going forward. We're going to have our latest unemployment data released this week, Graeme. So we'll look at that forensically next week. But certainly we're starting to see maybe just some early signs that the higher interest rates are starting to just tickle away at the labour market, and that's of course the plan. We want that, but we need to have a few more months, I believe, to establish a trend to show us that the economy is starting to respond to higher rates. So it'll be interesting to see that next lot of data when it comes out. We're also going to get population data, Graeme. The latest population data, and it's a bit backward looking, I know. It's the December quarter from the ABS. So that'll also be interesting to update just to see, how, and we know it's sort of the trends are very strong just to see our population's growing. But we, as you know, Graeme, we do look at more current data on populations, and that's overseas arrivals. And we'll look at the latest overseas arrival data if we get some time next week. So plenty to talk about. So perhaps we should get started with the...
let's rip in and have a look at the data.
What happened this week?
This bust that's meant to be happening. I'm dying to see it.
Yeah, well, so we're going to start with the horror story, Graeme. So this is the May rent report. And are you surprised? Yes, rents are rising and rising and rising and rising. You know, you get the gist. Nothing's really changed. In fact, when we look at the data, rents have continued to generally rise over May following the holiday month of April. Vacancy rates have plunged in most capitals as those chronically undersupplied rental markets again become fully focused after the holiday, distractions. And rents are rising and rising. And I mean, that's the point, Graeme, that April is a holiday month. It is, we have Easter, we have Anzac Day, school holidays. It all happens in April. And, of course, in the rental market, that means that landlords are less inclined to be active, tenants are less inclined to be active. So they are distracted, just like, most of the rest of the population. And but we saw that even though we did have some upward movement in vacancy rates over April, we still were seeing higher rents over April. It just shows you the energy in the rental markets, even through a holiday period. So for May, of course, we bounced back from the holidays and no surprise, we've seen some more really strong results coming through. Sydney house rents now up at $750 a week. That's a big number, Graeme, for the median house rent, up 3.4% over the month, and most of the capitals actually recorded a higher rents over the month, exception there Darwin, but Darwin's a very volatile. We only get small observations coming through, so it does tend to be a bit up and down from month to month, as we point out, and Canberra down too. But most of the capitals recorded increases over May. That big number in Sydney, though, is something to be alerted to, 3.4% over the month, Graeme. So over the past year, Brisbane's the clear driver of house rents in terms of the growth rate, 33.7% in rents in Brisbane. So,
you know what's interesting about that, Doc? When we first started working together many, many years, probably 3-4 years ago now, you and I did talk a lot about southeast Brisbane, specifically southeast Queensland, being quite undervalued because you had $400,000-$500,000 homes renting for $500-$600 a week, which is very abnormal in the Australian housing market.
Yeah, absolutely. Yeah, you're spot on, Graeme. And we did say then that the yields were too high. Yeah. So that something was going to give.
And it's very unlikely the yields just disappear. The values had to align with the yields.
Yeah. So now we've got the rents catching up with the values, which have gone through the roof. And that's the story for the same reason, and that's surging demand. And that demand, of course, as we know, came from those southern states, that exodus out of the lockdown states of Victoria and New South Wales. And that's continued to put upward pressure on rents. And what it means, of course, is that those yields have sort of fallen, but now they're consolidating with rents starting to catch up with the prices, so they're starting to get back to what they were. But, 33% increase, if you're a landlord, you've got to be feeling pretty good about that, Graeme, in Brisbane. It helps to offset, which I know is a challenge, those higher interest rates. But I guess if you are an investor, you have had the benefit of with your new listings coming through, new rental listings, of very, very strong growth there. And it's only Hobart, to a lesser degree Darwin and Canberra, that haven't had those very strong results that the major capital cities have had. Sydney up 17%, Melbourne up 16%, Adelaide up 11%. So these are good returns, as I said, if you're an investor, a landlord, and it does help if you've got a mortgage to offset those interest rate increases. And of course, what we know now is that you're also getting the benefit of capital growth coming through, which, obviously what was a negative last year, but now there's certainly plenty of catch-up energy with capital growth as well. So I guess it's the time really to be thinking about securing a rental property rather than, thinking about it's too hard, and I think that's what we'll be seeing, more investors coming into the market to take advantage of these very strong results. So that's we can see our vacancy rates there too. The change data didn't come up, but vacancy rates plunged, Graeme, over May. And of course, that's because they were generally higher or steady over April. And as we discussed before, that's a product of the holiday distractions. But look at those vacancy rates. They are crazy, Graeme. These are crazy. I mean, are we going to get zero? Look at this, 0.4, 0.3, are we going to actually have a zero vacancy rate here?
Crazy. Absolutely crazy and insane.
But it's a bit like when you look, the vacancy rate's a bit like when you look at the auction clearance rates and house prices. Vacancy rates tell you what's happening with rents, the same deal. The lower the vacancy rate.
And when you look at that too, 0.3, is that just a listing going up when someone is moving out and someone moving in a few days later or a week later? Like, really, you got to say we're at zero. There's nothing of it. The competition and the amount of people applying, it's insane. There's lineups up the street in some places.
Well, and the point to this, Graeme, really is once you get to these sort of levels, there's really nothing you can do to change it fundamentally. I don't think I can't look at the circumstances other than closing our borders again, where we will get back to what you would suggest would be a balanced vacancy rate, and that's around 2%. Look how far below 2% we are. 2 to 2.5% is sort of a balanced vacancy rate, where there's enough properties around to meet demand.
So I've got to ask this, Doc, because I'm getting asked this a lot, and this will come up on our event on Friday night when you're presenting again this week live. I have to ask this on behalf of our community. Is there a solution? Is there a Wilson metric or a Wilson proposition? I know, we don't want to go political and policymakers, but we're not approving enough homes. If you look back in, post-war time when the government invested, I looked at this, 26% of construction back post-war was actually social housing, right? Because we had a population boom, everyone came back. And about 26% of those homes being constructed annually were public housing. Now, it'd be lucky to be 3, 4, or 5%. And there's so much red tape for the development. What do we have to do here? I know the answer is build more homes, but how do we fix this?
Well, we can't. And there's, systemic problems there.
I'll call that the Wilson direct response.
Well, we can't. We can. We need to, have a national, building boom. Maybe we need to, instead of what's amusing, Graeme, is we have a shortage of supply. Okay, so we're always talking about new supply. Let's build more houses. Yeah. Obviously, if we build more houses, there's more to go around. But why is it that we keep kicking the investor? It's like all governments look at the investor like they've got a bad smell about them, right? We had those, APRA with their remarkable policies, and they say, we're just protecting the banks. We don't care what happens to the economy or the housing market. Which they should, of course. They don't say that. But they created a credit squeeze for investors, way back in 2016.
I'll go a step further. I just had one now. It was an expensive property. I just had 2 valuations completed with 2 different banks. They came in $350,000 apart.
Yeah.
That doesn't make any sense to me. The same property valued 24 hours apart with 2 different valuation firms, $350,000. It's a very expensive property, but how do you for mum and dad that are buying a new family home in Sydney for a couple of $1 million, that's the difference of getting their loan approved or not approved for their family home. And then you've got APRA, and then you've got this, and then you've got servicing buffers. Why are we kicking the investor when we need supplies of private rentals?
Exactly, and that's what. And valuation is a is an art, not a science, mate. Sorry, valuers out there, but you know what I'm saying is true.
It's an arts degree, is it?
Well, that's right. It's not a science. Anyway, and I'm an old valuer, so I can say that. I used to teach valuations, actually. But I think the point I'm trying to make, Graeme, is rather than disincentivizing investors, which is like the two-dimensional view of politics at the moment, like, they get rid of the investor and we'll fix everything. How are you going to get rid of the investor? That means fewer investment properties. Come on,
And we see this all over social stock. People are, it's un-Australian for people to own multiple homes. I can't buy a home. Well, the incentives are right, you could buy a home, but you're saying kick the investor that's putting the roof over your head right now. That doesn't make any sense either.
100%. And that's the point. Where are you going to live? Right?
Yeah.
And how come all these people can buy homes and you can't? So I don't know. What gives the investor the big advantage to be able to have multiple homes? It's the blame game to some degree. But wouldn't you think that, and I mean, this is really out of left field, but wouldn't you think that giving incentives to investors would be part of the solution to bring more private investors into the market who are prepared to take the risks? We give them some. They've got some really good advantages. I always admit that. We have a political system which does promote property investment and ownership, capital gains discounts, 50% capital gains discount as an investor, negative gearing, tax depreciation. These are all positive.
They did this in like 10, 11 years ago, Doctor, had the NRAS, the National Rental Affordability Scheme for low to mid-income earners, but they only did like 30, 50,000 dwellings. Like, wow, drop in the ocean. And now that's ended. Like, you're right. Why aren't we giving incentives like that, like tax-free or tax concessions? Or we should be stimulating the amount of investors in the market besides first home. Look, some people are never going to run a household budget and save money to pay a mortgage plus utilities. But the ones that are, shouldn't we be encouraging and rewarding them? I agree with you totally. Those people that are going to have a budget and are going to take all the risk, take on all the debt, all the repairs, all the maintenance, they should be incentivised.
Yeah. And the point is, Graeme, we've already got the mechanisms in place. So this isn't, an outrageous new policy position. We already have a capital gains discount for investors.
Yep.
We already have tax depreciation for investors. And we already have negative gearing. Let's just improve those benefits, even if it's a short-term position. But there's this sense that the more investors you have, the fewer homeowners you have, and maybe the big picture is to some degree appropriate. But that doesn't solve the disaster, which is the rental market at the moment, and the silly, policy positions which are just nonsensical thought bubbles that are coming up from politicians at the moment, such as the rental freeze, are only going to make things worse. Because if you disincentivize investors, you're only going to have fewer investment properties, you're only going to have higher rents, and you're only going to have people living in cardboard boxes. And we're going to have the cardboard box neighbourhoods that we see in the major cities on the west coast of America. And God help us if that happens. Or we're going to see shared housing, people owning a home and having it pass through the generations.
Wasn't that Governor Lowe's thing the other day that people can all move back in with mum and dad and they can share rooms?
Yeah, he's done a great job, Graeme, and we're really going to miss that guy when he leaves in September, which I think he will be. Unbelievable. But
anyway, we could bang on about this, Trev. We better keep going. We better stay focused on.
Yeah, all right. So that's the bad news story for the house rentals, Graeme. But hang on to your, fasten your seatbelt, hang on to your whatever, and here we go for the rental market for units, mate. And what do we have for units? We have another big rise with Sydney units, same as houses, up by 3.4%. Unit rents in Sydney are now $750 median a week.
Same as a house.
Same as a house, mate, and rising, up by 3.4%. look at Melbourne, mate. We predicted this. We predicted this. We said that Melbourne rental market was really set for some movement. 6.8% over the month, Graeme. It's now at $550. Look, it's $200 less than Sydney. So you can rent a unit in Melbourne. It's still high, compared to Sydney, great value. So it's coming from a really low base through the COVID lockdown period. And of course, we've got lots of migrants and students coming into Melbourne. But 6.8%, I had to check the data, but it is what it is. But only still at 550. Brisbane up 1.8%, 560 a week now. Adelaide up strongly, but it's only a very small unit market in Adelaide, Graeme, as we constantly say. Perth was flat. Hobart up, Darwin up, but again, Darwin is a very volatile rental market from month to month because of low observations. And Canberra steady. But look at these annual results, Graeme. Sydney up 40%, nearly 40% over the past year for units. Melbourne up 33.33%, Brisbane up 24.4%, and of course, this is the combination of the end of lockdown, migration starting again, and particularly, student migration. So it's, if we thought the house rental market was bad, check out that unit rental market, mate, not good. Look at these vacancy rates. Now, the whole story with Melbourne, and we said that vacancy rates are a good forward indicator for actual rents. Now, look at the vacancy rate in Melbourne. It's still at 1.2%, Graeme. And we're sort of saying, oh, wow, that's a very high vacancy rate. Well, no, actually, it's a very low vacancy rate. But when you compare it to the others, right, you can see why Melbourne is still reasonably affordable, comparatively affordable, when we look at the other states at 550, particularly versus Sydney. And you can see the difference in the vacancy rates. But the vacancy rates all plunged for units, as with houses, over May following April. So you're right, we could wax lyrical on and on and on about what we can do about the rental market. But unfortunately, Graeme, all we can do now from month to month is just to report the data. We're the first with the data. And as far as vacancy rates are concerned, we're the only ones that report vacancy rates for houses and units separately, not combined. And as you can see, that's a very positive metric because it allows us to differentiate between what's happening in the unit market and what's happening in the house market. And My Housing Market are the only providers of data on a monthly basis that do that at this stage. So no relief there, Graeme, and we're just going to have to, I guess, almost do an auto record for the next report because it's just the same every month. But, we are moving into a quieter period, so perhaps there'll be fewer prospective tenants out there looking for a place to live. But again, we've got all those migrants coming in from overseas. So let's with some sadness and regret, leave the rental market and head on to the latest economic news. We had the GDP numbers out last week, Graeme. Of course, first we've got to point out this is March quarter stuff. So it is, quite a while back. And, I'm not sure it's telling us anything. But for the record, we saw GDP up by 0.2% over the year over the March quarter. Sorry, it is the lowest result since that lockdown period. We are trending downwards with our GDP. I'm sure we got not all the usual, cacophony of doom and gloom, clickbaiters telling us about the imminent, realisation of a recession. That's just stupidity because even if we did get a technical recession with an unemployment rate still amongst the lowest we've ever recorded, we got a long, long way to go before we have the negatives of a recession, such as we had back in our previous recession, which, of course, is so long ago, I don't think I was even born. Well, I was, but it was 1991 and we had 10% plus unemployment there. So we've got a long way to go before the hard yards of a recession, which, of course, is high levels of unemployment, are realised. But nonetheless, 0.2%, the lowest we've had in terms of GDP growth, quarterly GDP growth. I want to mention a couple of things. Firstly, a lot of what we saw with that lower number was about the lowest since September 2021 is about the adjustment that we're still seeing post-COVID. So what's happening is all of a sudden we're getting more imports because the supply lines are opening up. So imports are now in excess of exports, and that's what's called net trade. And that means that because we're now getting all these imports coming in, we're getting more income from imports compared to exports, right? So that's had an effect on our GDP. So it's part of that post-COVID adjustment. We did see that the household savings ratio fall to 3.7%. No surprise with that, given, the higher interest rates, for example, as households having to find more of their savings. That's a trend that's been ongoing now for a year or so, fall in the savings ratio. Business investment was higher, though, up by 6% with equipment purchases, which still shows that the economy is strong. But as I said, a lot of these results do reflect the COVID adjustment impacts. So we need to take it all with a bit of a grain of salt, Graeme. So we'll just quickly look at, before we finish off, the latest house building costs in terms of the inflation environment. The latest data on house building costs, and of course we run our own index, which is a quarterly house building cost index, which is derived from ABS statistics. So this is the latest data for the April quarter, and we can see there's some improvement, even though it's a slight increase over April, and the costs still remain significantly higher compared to the same period last year. The actual rate of growth is starting to fall, Graeme. It's still very high, but the rate of growth is trending down. So you can see there, that's the incredible increase in house building costs that we've had.
So it's still increasing, Doc, but not increasing as a higher rate it's been increasing.
Yeah, that's exactly right. And that's the point, is that's its impact on inflation. So we're talking about building costs still high, still notionally rising, but it's the rate of annual growth is now falling, which means that will have less of an impact on the inflation rate, and therefore that gives us, one less thing to worry about in terms of higher inflation, which has been peculiar in a sense to Australia because of that home builder policy, which gives us maybe some hope that the outlook for interest rates, or the pause in interest rates, may be sooner, but it's a positive trend. But hey, Graeme, it's still very high, these building costs. And it's an issue for builders going forward. As I said, those rates, the annual rate of growth, building costs, house building costs, eased marginally over April, but they still remain at very high levels and are certainly placing pressure on profitability. You can see there, that's the annual growth trend. So it's not impacting as it was in terms of its impact on inflation going forward. So that's a bit of so-so news there on the economy. We'll have a lot more news next week. We've actually got, interestingly, Graeme, the US are going to announce what they're going to do with interest rates this week. There is a lot of chat that they're going to pause interest rates for the first time. That's what the markets are predicting, but you never follow the markets because they're wrong more than they're right. But they don't mind being wrong, because those that follow them, they get a margin on it. So anyway, that's another story. So we'll have a lot to report next week, and the latest unemployment data in relation to what's happening with interest rates and inflation. So last weekend was a holiday weekend, long weekend, Monarch's birthday, King's birthday, whatever it's called. We know auction clearance rates, we've discussed that already, follow house prices. Sydney and Melbourne, you can see that trend. More positive results last Saturday despite the long weekend holiday. Clearance rates were predictably lower because there was just a handful of auctions, really, than generally reported over a recent weekend. So here's the results, Graeme. 77% in Sydney again, ho-hum. Oh, what a shocker. But down from that 82.3% the previous weekend. But, gee, that's pretty good, Graeme. They had about half the amount of auctions. Of course, there were fewer higher-priced auctions, as mid to higher-priced auctions, as there typically are over holiday periods. Melbourne just had a handful of auctions, Graeme, just 253 auctions in Melbourne. Melbourne loves a long weekend, and there was lots of football on, so there's plenty of things to do. but still they had a 70% clearance rate, Graeme, which is still a very positive result for most sellers, 7 out of 10 going under the hammer. But as it's just a handful of auctions. Brisbane, which I don't think had the holiday weekend, but so its numbers were around about the same as the weekend before. But hey, look at this clearance rate in Brisbane, Graeme, 73.8%. The drums are certainly banging away in Brisbane that they're up and running. Adelaide had a holiday, half the auction numbers the weekend before, so it's even though it was a good result, it was still well below the typical 80% plus that Adelaide produces. In Canberra, just a handful of auctions. We had hardly any reported coming through, Graeme. So its clearance rate was down as well. So I think that was another positive weekend. Market up and running again this weekend, Graeme. Be interesting to see how it bounces back. Will Sydney get another 80% clearance rate? You wouldn't want to be betting against it, but we'll wait and see. But there'll be more auction numbers coming through than we had last weekend. But there's no doubt that this is a very strong market, particularly compared to the sort of clearance rates we were getting a year ago, which were significantly lower. And you can see that there. Sydney well up on a year ago. Similarly, Melbourne well ahead of a year ago. Brisbane also higher now than a year ago. Adelaide around about the same, but big results. And Canberra also now starting to track higher than a year ago. Get those auction clearance rates on my LinkedIn account every Saturday night and the full report on Sunday mornings. Next week, the May labour market report. We'll look at some regional house prices and rents, the latest population data, and, of course, the latest weekend auction results. And that's me for this week, Graeme. Very exciting.
Very exciting and it's insightful as always. So appreciate your time, Doc. I know everyone in our community does. And we'll see you Friday night. And then next week we'll be back with all that data again.
Yeah, interesting times. And we've still got a couple of weeks to run through till winter, Graeme. And that was a good point you made, that maybe the winter market won't be as quiet as we've seen. You know, still a lot of catch-up potential in our market. Sydney up 5%. Still 3% lower than where it was a year ago, but I reckon it's on course to do about a 10% this year. I reckon Brizzy will do, around 6% this year. Similarly, Melbourne. So all markets, going forward are in growth mode again, but it's catch-up mode with, what was a negative a year ago is certainly positive now. But a lot depends on interest rates, and the economic data will point us in that direction over coming weeks, Graeme, I hope.
Excellent. Thanks, Doc. We'll see you Friday.
Good on you, mate. I look forward to it.
Thank you.